Hello, this is Clark Kendall with Kendall Capital. It is the first week in July 2025, and I just want to address what's going on in the financial markets the first 6 months of this year. As we know, the S&P rallied in the second quarter up over 10%, and now year to date it's up just a few percentage points. One of the big factors in the market has been the foreign markets. Foreign markets also rallied over 10% and actually are up in the high teens on a year-to-date basis, depending upon which industry you look at. The majority of that reason is because the dollar's dropped in value. Dollar is down to other currencies about 10%, which has increased the relative performance of the foreign markets. When we look at the markets, what's created all the volatility over the second quarter? You gotta call a spade a spade. It's been the political issues affecting the market. First quarter it was Doge. The second quarter we had Liberation Day, and then we had basically the one big beautiful bill. All this has created enormous volatility in the marketplace. We're not political analysts, nor do we have a political opinion, but we need to take this into consideration of managing your money. So what do we do from here? I think we'd be conscientious. What is going on with the economy? The economy still is relatively strong. GDP has not gone negative. It is still continuing to grow, even though it slowed down a little bit. Corporate earnings are still up, and unemployment is still relatively low. I look to Jerome Powell as far as what's going on in the fixed income market, and he has basically stated several times that he wants to lower interest rates. He thinks interest rates should be lower, but he's held off waiting to see the full impact of tariffs and how that's going to affect the economy. What has that done? I think firsthand we've seen that have a major effect in the real estate market. Real estate prices have not come down, but what I like to refer to as the velocity, the changeover of real estate has dramatically slowed down. The reason why it hasn't come down is because we have a limited supply of real estate in the United States. And we have homeowners, many of them who have mortgages at 2 to 3%, who are not in a hurry by any means to sell it. An interesting fact is only about 40% of homes owned in the United States actually have a mortgage, 60% do not. The other key issue that we look at as far as looking at the economy is unemployment. Unemployment is only at 4.1%. And even though Doge basically let go over 300,000 of federal employees, on the opposite side of the coin, the reports I've read, is over 1 million illegal immigrants are no longer working. Basically, they've gone into a lay low status. So what do we do when managing accounts? Two things. We still continue to see opportunities of companies that have increased labor productivity efficiencies, and we see that in the AI market. But on the opposite side of the coin, we're very conscientious of the prices. Some of the valuations have stretched. So just like we've always done, we want to own good, profitable companies and own them at reasonable valuations. On the opposite side of the coin, what do you do and how do you take advantage of these higher interest rates? Well, we look to you, the clients, and when the clients want us to decrease volatility or the swings of their portfolio, we can use this opportunity to lock in some of the relatively high short-term interest rates in the fixed income market. We also use this as an opportunity to match your short-term cash needs, and we call that 2 to 4 years, with what's available in the marketplace. As always, there's volatility in the marketplace, but there's also opportunities, and we're using today's environment to manage your accounts accordingly. So please don't hesitate to call myself, Brian, Jason, Zeman, Carol, or Dave. We're here to help you on your journey. Clark Kendall at Kendall Capital.